Welcome back to another week of the Educated Home Buyer Live, where Josh and I teach you how to buy right, borrow smart, and build wealth through real estate ownership. We missed last week, so we've had 2 weeks since we last talked to you guys. We're happy to be back. It is Wednesday. We're here to answer your questions, like I said, and help you guys become the educated home buyer. So, Josh, how was vacation? Your 2-week hiatus.
Vacation was good. Mortgage vacations are interesting. You don't get to walk away from it. So it's a couple hours on the phone and clearing emails in the morning, but we got to hang out with my grandma, who is 100% awesome at all times. So that was fun. Got to see the in-laws, got to see my mom, got to golf some, got to see the Western United States. We went through Nevada, Arizona, Utah, Idaho, Montana, Washington, Oregon, California. So we got to see all of the Western U.S. Jeb, it was awesome.
Yeah, your wife said over 3,000 miles. You could have gotten back to my hometown.
We could have, but then we'd be stuck there.
No,
we'd
you can take a flight back. You just sell your truck, take a flight back. That's how easy it is. But tonight's episode is where are interest rates headed with Fed rate cuts. We're going to be talking a lot about that. In fact, we recorded an episode today that's going to post on Tuesday where we answered that question specifically with everything that's happening right now. Does the Fed, cutting rates in September ultimately mean that interest rates are heading lower? So if you're, interested in that question, we go over in detail. We talk about how mortgage rates are priced versus what happens with the Fed funds rate, all of that good stuff. But right now, we're going to do what we came here to do and update you guys on the economy, what's happening with supply, demand, everything out there to help you guys become educated home buyers. And then we'll answer your questions. So start putting them in the chat now. That way, when we're done, we can just flow right into it. All right, Josh, we like to start with inventory. Inventory this week is sitting at 704,000 single-family homes nationwide. That's up 6,000 week over week, and a little bit less than 1% growth for 2 weeks now. So slowing a little bit. Again, you can kind of look at those charts there and see that this is about the time when things flatline a little bit before they start coming down, which is right at the end of summer. We always like to look at Orange County. We like to look at Huntington Beach, where we're located, just to update you if you're watching in those areas, where we can be of real assistance to you, especially if you're looking to buy or sell real estate. But Orange County is sitting at 3,581 single-family homes. I think that's the highest number that we've seen since like October, November of 2022. So pretty good amount of inventory sitting on the market at the moment. That's up 2.4% week over week. So even though we weren't here last week, I still track the numbers so that we have a week over week number just to keep us on track. Huntington Beach sitting at 253 active properties on the market. Now, these include single-family condos, townhomes, leased land, senior communities, everything that's on the market in these areas. But that's up nearly 6% week over week. So this is the highest level of inventory that we've seen in Huntington going back again to 2022. I don't really know the month in there because we didn't track it back then, but pretty good stuff. We'll in a year or two, we're going to have some really good numbers. Weekly new listings, 65,000 new unsold properties with 12,000 properties going into immediate sales. That's 9% more sellers than last year, 4% fewer than last week. The idea is that seller volume is going to continue to decrease for the rest of the year. And you're going to see in a moment that we've got, I think, 7 or 8 states that are currently sitting back at 2019 levels when it comes to inventory. I don't remember the number exactly, but week over week, as I said, we went up about 6,000 homes from 698,473 to 704,744. This is the highest level of inventory that we've had in quite some time. For context, though, taking us back to 2015, 1,215,000 active single-family homes on the market at that time. So considerably lower than back at that time. And this is taking us back to 2019, just showing that difference in where we are now versus where we were then. Today sitting, 704,000. Back then we were 950,000 or so. So again, it's all about context, all about understanding where we were in a more normal market, where we're coming from. Regardless, we're getting more supply to the market, which is a positive thing, especially when it comes to buying a home out there. New contracts pending, 65,000 new single family contracts pending. That's slightly down from last week, but slightly up from last year. 368,000 total pending, which is 2% above last year. Again, puts us about a 4 million annual pace when it comes to existing home sales, which is about where we said they would be. Median price of new contracts. So median price, 449,000. That's unchanged year over year. New listings sitting at 400,000, which is somewhere around 0 to 2% above 2023. And pending sales, 385. That's 4% above 2023. And then we have Case-Shiller, I believe, Josh. Case-Shiller, what? Up what do we say? 0.2%
month over month.
There we go.
And the year over year puts it at 5.4. That 0.2 month over month, Jeb, seasonally adjusted. If you take out the adjustment, it was actually 0.5. But obviously, we're at the time of year when you should and would expect more sales.
There you go. Percent of properties with price reductions currently sitting at 39.9%, which is up slightly week over week, but not by much. And the idea is that price reductions are probably going to normalize here soon, stop going up just because of where we are with new listings coming to the market and inventory starting to decrease as we head into the slower time of year. Earlier, I said I said 7 to 8. It looks like 8 states that are back to 2019 levels when it comes to inventory. A lot of those states, Idaho, that's not Nevada, Idaho, Colorado, Utah, Idaho, Utah. Get confused, Josh. Those states just throw me for a loop.
The 4
Idaho,
Utah, just throw you off.
Both of those, Texas, was that Oklahoma, Florida, Louisiana, these market, that's not Louisiana, that's Alabama. Anyway, a lot of these states saw a lot of growth during that period of time, especially Texas, Florida, Idaho, parts of Utah, because of the work from home, because of people moving all over. So they saw a lot of appreciation, a lot of growth in those areas. And now you're seeing it normalize a little bit because it's not quite as crazy. Now, this chart takes us through population change back from 1970 to 2020. So Josh, what are we actually looking at here?
Well, Jeb, we always talk about fundamentals of economics, supply and demand. So demand, you have an increase in population, it increases demand for housing. If you have a decrease in population, it's going to decrease the demand for housing. So it was funny to kind of see this overlaid back and forth with yours. There's not really a lot of overlap. This red swath, from what is that, North and South Dakota straight down is where we lost the majority of population, probably due to the increased farming yields, less farm workers needed. So they've moved out to other areas. But that, again, tells you that is likely areas where you're going to see lesser home price appreciation, less demand for housing. This was a fun one here, Jeb. This shows 5 Midwestern cities, those basically that same swath of the country, where they have built more housing and what that has done to rents. So it's the change in median rent, not in home prices. But you'll notice Minneapolis has had the least change in rents. Rents are more affordable because they've built the most housing. So it's almost an exact inversion here. We've done episodes of the show with Ed Pinto, some others, talking about how difficult it is to build affordably and build the type of inventory that people want. But the areas that are doing it are being able to keep their housing costs a little bit more under control. Again, sticking with this theme, Jeb, of supply and demand. Talked about this for a long time. We are going through the next 10 years. We are going to have a great amount of demand. So the demand for homes, household creation, people coming of age where they want to buy homes is not going to be an issue. But yeah, the willing demand is there. We're going to talk a little bit here, and the theme of tonight's show. Interest rates, Fed cuts, lower interest rates. What does it do for affordability? What does it do for able demand? We have no lack of people who want and need to buy a home, but can they afford to reasonably? So through this in here, again, this is John Burns Consulting. They do their own affordability index. All of these are pretty similar. It takes into account home prices, interest rates, or the monthly payment, and wages. And you can see we're way, way, way above what the norms are. But as rates have come down, despite the fact that we see Case-Shiller, FHFA, home prices continue to go up, but at a more moderate pace. As interest rates come down, we're going to get back down somewhere approximating that orange line in the next 1 to 2 years if rates do what we believe they're going to do. So on that note, Jeb, here is what market expectations are out through next July of Fed funds rate expected change. So for September, we have a 0.34 cut. So you had talked about it this morning when we were recording. What do we have? 65% chance of a 25 basis point cut in September, 35%
I think it's down to like 62%, but the 50 basis point has gone up a little bit. Yeah, the 50 basis. Yeah.
So, and that's where you get that 0.34, sort of that blended expectation. But we go out through December, it's a little bit more than 1 point of cuts. There's only 3 Fed meetings, Jeb. So we've got, that's 4 cuts. That's 4 25 basis point cuts to get to 100 over 3 meetings. One of those needs to be 50. So we'll talk a little bit more about the just bulk of data. The last 10 days, the market has been flat. It's been really slow. Not a lot of good news or data that would move the market. But this Friday, we get PCE. Next week, we get non-farm payrolls. The following week, we get CPI. And then we're going to get that September meeting. So when you're looking at this, the market is once again expecting and pricing in 200 basis points of Fed cuts, not 200 basis points of lower mortgage rates. But we'll talk about that. Why is owning a home important? If you look for millennials and Gen X, real estate is far and away their number one asset. So it builds wealth faster. Over the long haul, you get to boomers and silent and earlier generation, then you start looking at stocks making up a bigger portion of their assets. But it is an important component of financial freedom, of being able to get yourself to a point where you've built up assets, you have a manageable monthly payment that is not subject to the whims of rent inflation. Jeb, I didn't go back and take this one out. So Jeb and I debated over this. It came out of context. And really what this is just showing you is over the last 10 years where rates have been. And the big gray cloud, we believe, is just showing you that the volume of sales occurred at those lower interest rates. So we have this gap. There was not a whole lot of activity that was done from, say, 4 3/4 interest rate up until about 6. Most buyers here over the last 2 years have been well over 6, and then most people that bought earlier in the last 10-year period.
And not necessarily sales, but refinance, people taking advantage of those rates. That's where the bulk of people are. So, yeah.
So when we look at that, it will be interesting because we don't know that we're ever going to see 2.5%, 3% again, but that gap should close and there should be more transactions occurring in that range there. This again shows percentage of outstanding 30-year conventional mortgages with at least a 50 basis point incentive to refinance. We've talked here on the show, our rule of thumb, take $125,000, divide it by your loan amount, and that tells you how much you need to save for it to make sense. If you have a $250,000 loan, then that tells you have to save at least 50 basis points. Well, you're seeing at the bottom right of the chart, we're seeing some people, what is that, 3.5% of the market eligible to refinance, whereas for the better part of the last 2 years, no one had any incentive to refinance, or virtually no one. And that's not true because we have been doing refinances. I do 1 or 2 a month over that time frame, but they're not opportunity based, they're need based, whether that someone needs cash, has a divorce, some other situation. I was going to take this one out, Jeb, but I thought this was interesting. We talk about portfolio lenders, community banks, credit unions making those loans. But from 2004 to 2023, went from 9,000 banking institutions, FDIC insured banking institutions. So this doesn't include credit unions, but we have basically half as many here 19 years later. And that's the consolidation. We have more banks in terms of bank locations, bank buildings, but we have less banks total. There's a Chase Bank seemingly on every corner in the United States. And if you're in a different part of the country, it may be another bank that you see everywhere. But the difference, Jeb, when you go back to the 70s and the 80s, a lot of people got their loans from a savings and loan, from a community bank. And you could have more of a relationship. They could make exceptions. They could do things for people that have relationships and ties to the community. And we don't see that anymore. Everything is really black and white. It's
the good old days, Josh, the good old days.
The good old days. You were like 2 and I was about 11 during the last of the good old days. Talking here, I thought this was interesting in that if we look at those gray bars, those 3 gray bars are the last 3 recessions. And remember that we don't know going through them that we are in recessions. The National Bureau of Economic Research comes back after the fact and says, here was the start, here was the end. But when you look at it, all of these were highlighted by an increase in delinquencies on credit cards. And here we are right now, have seen a pretty big uptick in the last 6 months. There are definitely other indicators that are saying we're absolutely not in a recession, but this is one telling us when they go back and declare that there was or wasn't a recession and date it, this could be a good indicator of it. So Jeb, in terms of interest rates, these we had to draw a new band, our little down channel. We broke below that a few weeks ago and have stayed below that. And the bottom of that channel is really now a good level of resistance of bond yields going higher. So a very good chance that we're going to stay below that. We closed the day at 383. We've been in that 380 range, 378, 379, 380 range for going on the better part of 3 weeks. So we got that nice pop down, but interest rates haven't changed much. We haven't talked about this a whole heck of a lot recently, so I threw it in, Jeb. Spreads, the spread between 10-year treasuries and mortgages that you're seeing. You can see that green line shows us that on the low end, for the better part of the last 20 years, it's about 1.25, 1.5 is the low end of that spread of where the 10-year treasury is, what you would add to it before you see what a mortgage rate is. On the high end, 2%. Well, we've been well above 2%, still well above it at 2.61. So that 3.8 treasury and your 2.6 spread tells us we're right here about 6.4% on a 30-year fixed mortgage. Now, we believe 10-year treasury is going lower. There are reasons to believe that we will continue moderating towards at least the high end of that range, the 2% spread. So depending on where those go and where those end up, we should have a good amount of room to the downside here in interest rates, which will increase affordability.
And I think we have one other slide, Josh, do we?
It's our pretty map, Jeb. Look how pretty that map is.
Look at that. So those states that are red, or what states that Josh can actually help in, can help you get refinance, can look at it if you're already in the process of refinancing to see if you're actually getting a good deal, tell you if you're getting a good deal. If not, can help you get a better deal. And the states that are blue will actually put you in touch with our referral partner, David, who does the other states out there. Also equally as charming and as knowledgeable as Josh. Josh just isn't licensed in those states, and therefore we have to pass it along to Mr. David. But if we could be of assistance to you, what I'm going to do is I'm going to put a little banner across the bottom of the screen here that you can go to, and that'll get you in touch with us, and we can get you in touch with Josh and or David. So with that said, Josh, we'll give people a moment here to look at that, and then we'll transition out of that. And what I will say is that if you are, here's a little success story, if we shall. Today is 30th, 28th of the month. In the last 4 days, I have had 4 people that reached out to me that I referred to an agent in another state close on their deal. So people that reached out, I've been able to connect them. One in Texas. I don't know if that one's closed yet, getting ready to close. Josh.
No, Gabe closed yesterday.
Okay, so that one closed. Nevada closed.
North Carolina,
and then San Diego. So 4 right there in the last couple of days. And so if you need help somewhere else, you need a knowledgeable agent, reach out. Happy to make the referral. Josh can get you hooked up on the loan. Either way, you'll get a good deal. You'll be happy, and bells will ring, and people will celebrate. The Pope might actually call you.
Jeb, all 4 of those stories are very good stories of your referral. I think we did the loans on 3, if not 4. We did the loans on 3 of the 4. And the one that we didn't do the loan on is probably the one that I'm most proud of. A viewer to the show, I screwed up. She sent us an awesome picture of her closing, and I was supposed to put it in the slides here. But Sheila had watched the show, had asked a question, and she has a unique situation. She was W-2. So we get this question all the time, Jeb, can you go from W-2 to being self-employed without having to wait 2 years? She's been self-employed right about 1 year. And that's a difficult one. It was a VA loan. She reached out. I shopped with all of my investors. We found one that was willing to do it. And she was actually in Nevada. And at the time, our company and our team was still waiting for our Nevada approval to come through. So we had to connect her with another guy I know out there that works with that same lender. And she was able to go through that and got that closed. And between that referral, where we referred it out to a lender that I knew could handle it, and you getting him connected with a great realtor that put it all together, she was able to get a home where many people had told her that she was not able to do that. So Sheila, congratulations. Thank you for watching. We appreciate you reaching out and giving us that opportunity, even though we didn't get to help directly. It was awesome watching you do that.
All right, good stuff. Guys, it looks like the Willing Show in the comments. You guys have to save me from that. We love Willing, but I can't read that many comments, not even close to that. So what we're going to do is we're going to start with some comments to get us kind of moving along. If you have questions, put them in there, guys. That's why we're here. We want to educate. We want to guide you through the process. We want to be a resource for you so that you feel comfortable making the decisions, right? So you can have that success story. But Mitchell says, what's good, fellas? Question for you. I need to save 0.35% to make a refi worth it. I have a 6.375 7/1 ARM. Just got it in May. Can I do an early refinance before 1 year? And how low do you need to see it going? So the question is, yes, you can do it prior to 1 year. The question about how much or how low do you, how long, how low
do you see the rates going?
Got it. So first off, I'm in a similar position. I had a 7/1 ARM, right? So in November bought another house, had 7%, was able to refinance into 6.5%, and just recently locked in a 6% rate on the day that rates went down the lowest. In fact, today's episode, we talk about that story where I was able to lock that in, how I was able to take advantage of it. But nevertheless, signing loan docs, closing on Friday, or signing loan docs on Friday or Saturday, and then closing next week. Nevertheless, very, very similar situation. Question is, how low do we see rates going? Good question. I still stick with the idea that rates are going to be below 6% by the end of the year. Sometime in 2024, you're going to see a 30-year fixed conventional rate under 6%. I said that at the beginning of the year. I believe it to still be the case right now. When, how long, I don't know. But how low do we see them going? Josh, I think 2025 rates could be in the low fives. Not really ready to predict a 4%er yet, but without knowing where we are at the beginning of the year, but it'll be interesting to see.
Well, let's back our way into it, Jeb. If we were just looking at the spreads, there's reason to believe that spreads will remain elevated in perpetuity from where we saw them previously. But let's say they go down to the high end of that range at 2%. So to get a 4 handle on an interest rate, you would need the 10-year at 2.875 versus and a 2% spread would get you to 4.875. That's a doable number. It's a doable number in 2025. It's going to be data dependent. You're going to see a slowing economy. You're going to see inflation moderating a lot. Someone who I follow and respect, read his report every morning, David Rosenberg, goes through and points out all of the disinflationary things that he's seeing in the economy. Not deflationary, not prices coming down, but disinflationary impacts. And he rightfully points out that in 2019, the 10-year treasury was at 1.75. So could we get there without government intervention, without the Fed pushing things lower? You absolutely could. So 1.75 with a 2% spread, with a 2.25 spread, get you to the low end of the 4% range. So Josh is not saying, Jeb is not saying that is going to happen, but it is not as far outside of the realm of possibility of what people think. We're all shell shocked from the 2 years of post-COVID inflation that was higher and longer than anyone expected. I definitely think that they will continue to moderate. So it kind of goes back to the question, Jeb, that we went through on the podcast today as we were recording it. What does that mean you do? If you think rates are going lower, we think they're going lower. We don't know that for a fact. We've seen head fakes over the last couple of years. If you have a large enough loan that a low or no cost refinance makes sense to ring that cash register, by all means, lock in some of those gains on the way down. Again, you don't want to have a bunch of sunk costs where you don't want to do it again. But if you have a $400,000, $500,000, $600,000 loan, even a $350,000 loan, if you can drop that rate 0.5% and not pay much in the way of closing costs, then it absolutely makes sense for you to go ahead and do that, and then look forward and say, hey, our rate's going to drop another 0.5% where I can stair step it down.
All right, I'm going to answer this question in just a moment. It's in the chat, but I'm going to read you guys something, and I want you to answer for me what you think the right answer is. I had a viewer. I don't know if they're a viewer of YouTube or they just found. Well, I'm assuming they're YouTube, but they contacted me through Instagram. They sent me a DM, And basically this is the message. They're looking at refinancing and asked me what I thought about it. And I said, well, I need more specifics. Give me more specifics about what you're trying to go through. So original loan was at 250. Current principal's at 246. Okay. They currently have a 6.5% interest rate. And then they went over their monthly payment and all that stuff. They go on to tell me that the new loan amount, so remember they bought it at 250, they owe 246. The refinance that they're considering getting is at 5.625%. Okay, that's on a 20-year loan. So they're going from a 30-year loan to a 20-year loan, and the lender is telling them, "Hey, yes, you're going down in rate, but here's the key. You're saving 10 years on your mortgage. From a 30-year mortgage, now you're only going to get a 10-year mortgage." Okay? Payment's basically going to stay the same. So there's not an improvement in the payment. But here's the kicker. The balance, the new mortgage, $260,000. $14,000 more than they currently owe on the home.
$10,000 more than the original loan.
Exactly. So tell me in the chat why or what they should do. Should they refinance? And if so, why do you think so? So if you say yes, why? And if you think no, tell me why. And then in the meantime, we're going to address this question. Then we'll go back and read your comments because I'm interested to see how much you've actually learned on the Educated Homebuyer podcast. So Mina says, is it worth buying down the rate? I set to close on the 9th. On my 0-point rate, it's 7.5%. Think of buying it down to 5.9% for $12K. Loan officer saying not to, and to refinance and buy down the rate then. So I got two comments on this. One,
I got some questions too.
Is it the 9th? The 9th, I realize, is right around the corner. You got a holiday in there. You got some weekends in there. But if I were you, I would be out shopping for a new loan prior to closing on this one, just based on where rates are, personally speaking. Now, it might not be able to close on the 9th, but I would be talking to people trying to make that happen and trying to talk to my agent to get me a little bit more time to make that happen if possible. Going back to your direct question, should you buy down the rate? My answer is no. You should absolutely not buy down the rate because where you are at the moment and where the market is already a huge savings. And if and when rates go down lower, you're going to be able to take advantage of it again. And you don't want to pay, you don't want to have sunk cost in there. And I think Josh is going to affirm that, but I know you had some questions, Josh.
Well, she gave us some additional details. So 30-year fixed, $460,000 loan amount. So 20% down, 710 credit score. This is a good loan. So we showed at the top, the slides, the Mortgage News Daily Report says 6.34 is what you should expect today. Now, that generally is 25% down. So maybe there's a little bit of a hit for only 20% down. 710 credit score. We know Fannie Freddie goes to 780 is the highest tier, and you get a little hit at 760, 740, 720. But 710 is still a good credit score with a 20% down. There is no world in which this rate should be 7.5%. If you locked 30 days ago, the rate shouldn't be 7.5%. So even though we've seen huge improvement, that rate never should have been at that point. So not sure who you're working with on that, but much to Jeb's point, reach out to us, use the referral link, email one of us directly. Even if it's not a matter of changing, we've had people reach out. We send them a loan estimate of what it looks like today, and magically the loan officer they're working with is able to do something in terms of getting them a better interest rate. We don't need to get to 6.34 to make this make sense. 0 points at 6.75 for what you're telling me should be very doable. So from there, now we go to that question. 3 points, $12,000, almost 3 points, 2.5 points. There's no world in which anyone should ever pay 2.5 points. And Jeb, this almost came up when you and I were having a conversation earlier today. I said, okay, it was when you were asking me about the guy that reached out, the same question you just asked them. So when might it make sense? I've had people who are going to be retiring in 3 months. So great, rates may be lower next year, but this is the last time we have their income to qualify. So they're like, screw it, I'll pay some points. I want the best rate that I can get for while I still qualify. There are certain instances where it could make sense. 99.9% of the time, There is no world. We are still to the high end of the range of where interest rates have been over the last 40 years. Every trend seems to be telling us it's going to be significantly lower. So on a $450,000, $460,000 loan, for you to save $12,000, I think she went ahead and followed up again, what, $500 savings in the monthly payment? Yeah, $500 off principal and interest. You're still looking at 60 months before you recoup the $12,000. You are going to have a much better refinance opportunity in the next 60 months versus paying $12,000 to get a vanity rate right now. But at least reach out to someone.
You could close on that loan and refinance it a month later at a better rate than what you've got, assuming, barring that you still qualify all the things that need to happen. But yeah, and Josh said, reach out to us. We would be a really good source for you. But if you say, hey, I don't even want to reach out to you guys, reach out to someone, get someone else to talk and go through that, because I have a feeling, the rate's 6.5, not 7. Is that? No. Oh, that's somebody else. Too funny. Yeah, go through it, because again, that's a lot of money to save, and you can eliminate the hassle of having to refinance sooner than later and saving your $12,000. So going back to the question I answered, nobody came up with an answer other than Stefan. And Stefan says they should not refinance because it will reset the interest. Yes and no. In this case, they were going from a 30-year fixed. However many years they had left was hard to say, because it said they started at 250. They were down to 246. And, it doesn't seem like they've had the loan for that many years. But nevertheless, they were going to a 20-year mortgage, so they were actually going to end up paying less interest over the course of that loan. But the key is they were being charged $14,000 in cost to do that loan, and it was being rolled back to the balance. So their equity that that they had in that property is essentially not being eliminated entirely, because we don't know what the property's worth, but you're losing $14,000 of equity in what seems like what they're promoting as a good deal. And they're promoting it as a good deal because of the way they laid it out. It's not a good deal. You're probably paying 2 to 3 points for that 5.625% rate, because that's not a rate that's available today on a 20-year fixed mortgage. So just be careful. And then when I asked him, I said, hey, do you have a loan estimate? No, I don't have a loan estimate. I just have the spreadsheet they sent me. Be wary. Be careful of anything when you don't have a loan estimate. You don't have something to base it off of. You just have some person in a conversation. And what I will tell you is that this company is the biggest company out there when it comes to marketing and advertising for mortgages. So, know that they got to pay for that advertising somehow. Anyhow, I digress.
Anytime. So here's the thing. Don't get hung up on loan estimate. A detailed fee worksheet is acceptable. If they can show you everything that you are paying and how you got to that $14,000 higher loan, that's fine. The LE is an important format, and you will get it when that time is appropriate. But when they have their own spreadsheet and they start trying to dazzle you with bullshit that you're going to save $43,000 because you're going from a 28.5-year loan down to a 20-year, that's a sign that they're not serious about telling you what the savings is. And even if you want to do that, if you want to do a 20 or a 15, have them show you what a 30-year looks like, because that's apples to apples. Even if you have zero interest in doing a 30-year, do that apples to apples comparison, so you could see in this situation, the majority of the savings was coming from paying points. I don't have to do that. If I got $14,000 extra dollars, I could pay an extra principal payment, or a large principal payment, and realize some of that savings. But back to Stefan's comment here, reset the interest. I get this question from people a lot. Well, I don't know if I want to do this. I've had this loan for a year and a half. I only have 28.5 years remaining. We absolutely can with almost all of our investors. So most lenders should be able to do a custom term, at least down to the year, if not down to the month. So if you want a 28.5-year loan on the new one, cool. Realize that is a valid choice for you to make when you're refinancing, not for the loan officer, not for someone to present you with, hey, I'm thinking this is what you should do. It's pencil it all out and say, do you want to have more cash flow on a monthly basis, or do we want to keep progressing month after month towards having this mortgage paid off? Because it might be a valid option to go down to a 20-year. It might be a valid option to do it at 28.5 years of what's remaining. It might be a valid option for you, in the best situation for you, to minimize that payment and go back to 30 years. But that's your decision, and you need help quantifying it because you're not the person that does this on a day-to-day basis.
No, good stuff. Coors Light. Coors Light's here, Josh.
Sponsor.
Fantastic. We are looking for sponsorships. Coors Light would be a good one. Your loan officer might say, I'm so sorry, but that was a typo. The rate is 6.5, not 7.5. Even if they do that, run far, run fast, find someone new, please. And then Mick M, if you're wondering who it was, you might want to read that comment. I didn't put it in there, but I think that's the company that I saw, if I remember correctly. Me says, hey guys, question. I sell?
You're asking yourself?
Me. Yes, I'm asking this I don't know the answer. I'm looking for it. Can I sell both my houses and buy one bigger and use that 1099 tax thing? So I think the thingy that you're talking about is a 1031 tax exchange. And how that works is that's on an investment property, and that goes from a like kind investment to another like kind investment, if you will. So if you're selling a single family home that's an investment property, you can transfer the gains in that property to a new residential property, investment property, and not have to pay capital gains on those or taxes on those gains until some point in the future, if you will. So when you're selling two properties, it depends on how you have those properties classified. Your primary home, when you sell it, you get $250,000 in tax-free gains for a single individual, $500,000 for you and a partner, a married partner, get $500,000 in tax-free gains. Anything above and beyond that can be taxed. So say, for example, you bought a house for $500,000. It's worth $1.5 million now. Well, 500,000 of that is essentially tax-free if you're married, let's say you are, and then that other 500,000 could be taxed. Now, there are some things that could adjust that tax basis, closing costs, improvements, different things you've done to that property can come out of those gains, but you can't just take all of your gains and roll it into a new property and not be taxed unless you fall under those brackets, because that's essentially where the tax code came from. The 1031 tax code, the capital gains tax code came, it was changed, I think, in like 1978, 1980, whatever year it was, Josh, where they took away where you just had to, if you put all your gains into a new property, you didn't have to pay taxes. Well, the new one is now you get the $250,000, $500,000. So going back to your question, how is the other property classified? If that's an investment, you're selling that too, then you might have some taxes that you have to pay on that, because you can't take gains from an investment property, put them into a property you're going to live in, and get away with the tax-free part of that deal. Now, Josh, there might be an opportunity where you could put it into a multifamily property, if you will. Live in one unit, rent the others out. There might be an opportunity for you to pass them along some of the capital gains in that investment side of that piece, but I don't know. That's a CPA question.
Yeah, it's very detailed. You don't want to run afoul of this. So even if Jeb and I have the right answer, you absolutely want to make sure you have a tax professional signing off on it before you make any decisions.
Yeah, we are not. Josh is pretty good tax guy over here. But he didn't have the answer.
I stayed at the Holiday Inn Express last night.
There you go. Let's see. Let's go with this one. William Cathcart. I have 10% down payment saved up. Do you think using the down payment assistance is worth it? I know some have different stipulations, but in general, are they worth it for a lot of first-time home buyers? So understand, first-time home buyer down payment assistance programs not only vary by county, they vary by state. There's a lot of differences in these, but most of these programs are not free down payment assistance. They are silent second mortgages that end up on title that at some point you end up paying off. If I'm saying that correctly, Josh, is that right? Most of them are silent seconds that have to be paid off at some point?
Most of them are secured by lien. They're not a grant. They're not giving you money. They're giving you the use of money that you will have to repay in the future. And that generally creates restrictions for you. So if you find a program that is a grant, that is truly your money, or some of them will stay in the home for 3 years and it's forgiven. You're like, okay, I might be willing to not only stay in the home and make that payment, I might be willing to forego refinancing for 3 years if I get $15,000, $20,000, $30,000 towards my purchase. You have to quantify what that number is for you and what it would look like going forward. I have no problem telling you guys, I am not a big fan of any assistance programs. What we have in California, whether it's the GSFA Platinum, primarily the Cal HFA, they're all liens against your property, and they make fairly significant restrictions for you going forward. And you have restrictions during the process, and generally a higher interest rate than what you can get otherwise. Now, that being said, I've seen programs in other parts of the country. Saw one in Tennessee a few months ago that I'm like, I would do this. This is a great program. So I'm not against anyone researching it and checking it out. For the most part, the bad outweighs the good, and it should be sort of a last resort. So for someone that has 10% down, what my approach is, let's do it. Let's look at Cal HFA here in California, and let's look at a standard 10% down. Or if you reach out and you say, hey, Dallas Fort Worth, there's this program, what do you think about that versus a 10% down conventional? We're going to get the details. We're going to pencil it out on paper, and you're going to look at it. I don't ever have to tell anyone. It is very, very rare that the answer, when it's correctly analyzed and put on paper, doesn't jump out to someone. You guys are smart. You know what the right answer is.
All right, good stuff. I think we're being insulted here, Josh, but I'm not 100% sure. Mitchell says, I think y'all like Bud Light more. So I'm pretty sure he thinks we're more Bud Light guys. And, I don't take that lightly, Josh. I'm
offended. I'm offended.
I'm
going to get my gun and shoot up the case of Bud Light.
Listen, here's what I'll say. I've been watching. Do you ever watch the show Alone? Have you seen it on Netflix?
Mm-mm.
It's where they drop these people. There's like,
we're out in the wilderness where you're going to die,
and where you record yourself, right? So the last season, or the season I just watched, because I don't watch them all. I've seen the show before. I thought I would watch it. These guys are in Saskatchewan, up in Canada, northern, like Canada, like the damn Arctic, right? I've realized, Josh, I am inadequate as a man after watching this show. I mean, these dudes stayed out there. The guy that won was out there like 64, 65 days. Not only did he build it, I mean, there's females out there, Josh, that are building log cabins and
killing stuff and eating. And
everything. Dude. I thought I was a good camper. Like, I can go sleep in a tent. I can make a fire. These people are legit, dude. Like, I realized I deserve, like, nobody called me a man. I am a boy for life after seeing that.
No, yeah, we are city slickers for sure. On that topic, as long as we're doing the TV section of the show, have you seen Wyatt Earp on Netflix?
I have not.
Oh, it's fantastic. You got to go watch it. It's half like cheesy reenactment with not great actors, but then they bring in the historians to tell you what was actually going on. So it's part like History Channel, part like telenovela. It's good. I like it.
Good stuff. You always love a good novella. Lucy Fine says, hey guys, been watching your videos to gain knowledge, and you are amazing. No fear mongering, truth and facts. I appreciate it. Thank you. Thank you for the comment. That means a lot. Thank you for supporting the show. Also means a lot. You do have a question here. I flagged it. I'm going to try to grab it here in a moment once I find it. Here it is. It says, selling our first home and buying a bigger home, thinking of using some agent for listing and buying, but confused with the commission we would have to pay. Any thoughts? So, yes, I did a video on this. I posted it last Friday on my channel. Go watch that video. It's a detailed video. It's like 9 minutes long. It's a short video, but it is my best interpretation of what the commission looks like. So I'll break it down as quickly as I can here without taking much of the show. It'll take me a minute or so, but as a seller, you have options. You have to pay your selling agent to sell the house. So whatever that fee is, that's what you pay. You don't have to pay a buyer's agent. That is no longer, it's never been required, but now it is definitely not required. And so that commission, that compensation rather, that you would normally pay to a buyer's agent, you can continue to pay to that buyer's agent if you choose to do so. You can pay part of that commission to that compensation to a buyer's agent if you choose. You can pay none of it. You can negotiate. You can do all of these different things. But the buyer's agent can also come in and request compensation, and you can negotiate it. You can do different things. The buyer can actually come in and build it into the price of their home. So say you're listing your home for $500,000, they can ask for $515,000. if they were paying their agent $15,000 in compensation, and then that $15,000, assuming you agree to it, can be paid to their agent. So there's essentially 4 different ways an agent can be paid, a buyer's agent. I break it all down in that video. It's a good video. Again, you said we're not fear mongering. We're not. That video is very clear and short, if you will, in trying to explain what it means. So go check it out. It is on there. I think it's not the most recent video, but the video prior to that. So hopefully that helps. All right, Josh, Joyce asked a question here. I don't know if we have all the information, but we're going to try to go with it. Lenders offering 5.75% refinance for a $5,006 estimated closing cost on a 30-year fixed loan at a balance of $442,000. Our existing loan is 7.235 at $440,000. She goes on to say existing balance is $434,000 now. So essentially her balance, lender gave a spreadsheet on a VA loan. Does sound like the worst fees because okay. So the VA loan, existing balance 434. They're taking it up to 442. So that's $8,000, $7,500 in closing costs right there. That's being added to the balance of the loan. But the rate's dropping to 5.75%. It looks like, I'm not sure where the $5,006 estimated closing cost comes in, Josh. So if you have it clear, then break it out.
No. The answer is no. So VA loan, let's go back to the top of the show. Mortgage News Daily is showing 575. So hopefully this is a VA IRRRL. If it's a VA IRRRL, Joyce, I forget where you're at, but I do remember it was VA, even though you went ahead and told us kindly to confirm that, so I didn't have to ask. And I forget where you are, but I believe it's in a state where we cannot help. But through September 3rd, VA IRRRL, FHA Streamline, we have an investor that is absolutely buying the market on this, and you can do much, much better than that. You can get that rate or better without paying anything for it. If I'm right and you're in a state where we can't help, I can absolutely get you connected to someone that can. Just know there's no way you're going to add that to your loan amount for that interest rate on a VA IRRRL. So,
or you shouldn't, rather. Is what Josh
I'm telling you, you can't. I will come to your house and take the pen out of your hand to keep you from signing the loan documents. But the important part about that is that lender or that investor that we have, they're cutting that off on September 3rd. Hopefully they'll extend it. They've been doing it for us for about a month. So if you are in an FHA or a VA loan and you want the absolute best terms, they are a good 0.25% better than anyone else we have access to. And we have some other lenders with really, really good terms. So got a couple of listeners that we're doing FHA streamlines for at that 575, 5.61. I think we got one of them locked at with literally no costs, covering title, escrow, nothing in box A, the whole 9 yards. So it really is a very, very good deal. And not just us, we're not the only one that has access to this investor. It is out there and it is available even if you're in a state where we cannot help you. So reach out, let us get you connected with someone, but do it sooner rather than later because they have to be locked before September 3rd. Not that we go back to the top of the show, Jeb, you and I both think rates are going lower, but this is sort of like a time machine to skip ahead in time a couple of months and get rates, where they're likely to be 2-3 months down the line.
Good stuff. So that referral link in the bottom will get you to us. It's JebSmith, JebSmith.net/referral. So that'll get you in touch with Josh and myself.
And put in the notes that you're thinking a streamline or an IRRRL, because we'll know it's time sensitive, and make sure you get connected out to someone in another state or that we get to you right away. Just because we do have that little window there.
Got it. I gave myself a $1 super sticker in case you guys were wondering. I just wanted to pop on the screen. So I'm thanking myself for that. Elisa says, how do I know if I'm paying? Well, did I click on it? Yeah. How do I know if I'm paying too much to refinance? Do you have a recommended range? So Josh, what is too much?
There's not really a right answer here. It depends on where you are at. I just had one here in Florida that, boy, and it was a listener to the show, had reached out. And I think there was almost $2,000 of transfer taxes. We don't have any of that in California. I shouldn't say that. Oakland has a funky one, a couple other parts in the Bay Area. They're really blue cities. They like to tax everything. So it can vary all over the place. But I would say that plus or minus $3,000 Could it be as low as 2,000? Could it be as high as 4,000? That's reasonable before you get into any of those transfer taxes. One of the things I think is really, 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 really important. I have people all the time. We send out a loan estimate. They go, "Oh my God, you said my closing costs were $2,300. This says it's 12,000." Like, that's what it says on the loan estimate, because the loan estimate labels all of your prepaids to establish your tax and insurance impounds. It labels them as closing costs. It lumps it all together, says your closing costs for this loan are this much. They are not actual closing costs. So I think it's a reasonable number, absent any transfer taxes or other taxes that you would pay in your area. Plus or minus $3,000. A really thin lender could have it at 2,000. An expensive one is maybe up at 4,000. And again, title and escrow can vary. So if you're getting a quote of $3,500, $4,000, you may be in an area where title insurance is just more expensive, or it's an attorney state in the way it's structured. So it varies a lot, but I still think that 3,000 figure plus or minus is a good number.
All right, good stuff. I'd like everybody to stop what they're doing at the moment. And I'd like you to go to your phone or your TV or your computer and click the thumbs up button if you found any value tonight. It helps the algorithm, helps us push out to more people, helps us accomplish our goal, helping educate home buyers and sellers. And ultimately, that's why we're here, right? Spend an hour every single week away from our families to help, guide you guys through this process. And we don't ask for a lot, but we're asking for that because it does help. And if you haven't subscribed, if you're on the Educated Homebuyer watching, subscribe. If you're here on my channel watching, subscribe. It does help. And if you're listening on the podcast, this goes on the podcast every Friday. You can listen to us while you work out if you'd like. You can rate us and review us, and that does help as well. So that's my last pitch for that. But just know that we're thankful for you listening.
Jeb, right. I feel bad. I should have remembered this. Joyce is VA in VA. She's in Virginia. So Joyce,
you have
we recently got approved. The company got approved in Virginia. My license hasn't gone through, but one of our team members can actually do that. So use the referral link. We can absolutely do 575 without adding anything to your loan. And if you want, for some reason, a larger loan, we can get a lower interest rate than that.
All right, there you go. Josh, we've got Jess here asking if you can help with grants or first-time homebuyer programs in California.
So the answer is yes. It goes back to that Cal HFA or the GSFA Platinum. I do not love any of those programs, but definitely give us a call. Use the referral link. We'll go through it and we'll show you what those options look like. Do I think using a Cal HFA loan is better than not buying at all? Absolutely. So we can absolutely help you with that.
All right. Willing asked a question early on and says, if you own a property free and clear, can you do a cash out refi or rate term refi for VA or USDA? Or do you have to have an existing VA or USDA to do a refinance with them, Josh? So can you take a conventional loan and refinance it with VA or USDA? Is that an option?
Yeah. Yes. No requirement as long as you are.
As long as you're a veteran.
So if you're a veteran or if the property is USDA eligible and you meet the income requirements, you can absolutely use that financing regardless of whether the home's free and clear or if it has another type of loan on the property.
All right. Josh, we don't have a lot of other questions here.
Well, now we got a good one.
Well, how did I clicked on this? Is that the same one? I don't know. Guys, please help me with advice on a Navy Fed 0 down, no PMI loan. So need a little bit more information. Josh, I mean, we need rate, we need, fees, unless you have the answer.
I can Google it. So let's do that. When we get to a question that you have, we'll Google it and we'll come back to that. It comes up every now and again. It doesn't come up often enough that I think it's awesome. If it were awesome, it's a well-known program. So if it were amazing, we would have more people taking advantage. But let me take a look at it when Jeb is answering another question. But this is the one that I wanted to answer here, Jeb. Steve is in California. 100% VA disability rating. It can reduce your housing taxes. Can you explain that? Also, is there any benefit with a 90% rating that you know of regarding home taxes? I would have to look it up. My understanding is California, you have to have 100% permanent total disability rating. If you do, you get a deduction in your assessed value. And the number is escaping me. It's less than 170,000, but really, really close. It's like $169,000. So if you buy a home and it's assessed at $1 million instead of paying taxes on $1 million valuation, you're going to pay that tax rate for that property against $1 million minus the $169,000. So it's a very nice benefit. If we say in general, California property tax rates are about 1.25%. 169,000 is going to save you a couple $1,000s a year, a couple $100 on your monthly payment. Not as great as the great state of Texas, the Republic of Texas, where 100% P&T veterans are completely exempt from paying property taxes. So maybe consider moving to Texas.
All right. Let's see here. Mick M is, I think this is the whole thing. It says monthly they have a $22,683 payment. I guess it looks like the principal balance is $2,571,000. Josh, currently have an 8.25% rate is what 2.5% rate. Asking about a refinance. They bought in May. California. I'm trying to go through all the pieces here. Principal paid $3,294. Interest amount $35,386. So Josh, is there an opportunity to refinance somebody that has a $2.5 million loan that's currently sitting at 8.25%?
So in a short answer is absolutely, but you're in a unique situation. That's a jumbo, some would consider a super jumbo loan above $2.5 million. You get less options, you have higher interest rates, but all of the jumbo stuff that I've been looking at is much, much better than that right now currently. So you're in California. I happen to be in California. I would be happy to look at it and tell you what's available. It doesn't take at a $2.5 million loan. If you can save 1/8% in interest, going from 8.25% to 8% would be a significant savings and probably more than enough to offset any cost of refinancing. So if you can go from 8.25% to 7.5%, 7.25%, 6.875%, it's going to be a world of difference in terms of what you're paying monthly. So I would say absolutely yes, but if we have a unique program, if it's bank statement, a P&L program, a DSCR, any of that weird, crazy stuff out there, your rate may not be all that unreasonable. But reach out, happy to go through it and see what's available and what we could possibly do for you.
Good stuff. jebsmith.net/referral. It's scrolling there at the bottom. It's also in the description of the video. That'll get you in touch with Josh. So Abhinav has a very easy question to answer. Josh says, sorry, guys, just joined. Do you think the housing market bubble burst anytime soon? As the houses are marked up 25% higher than during the Trump administration. The median home prices then were $300,000 to $450,000. So let me be very clear. No, the housing market is not going to burst anytime soon. For so many reasons that we talk about every single week here. This is not a fear-mongering channel. It is a very straightforward, pragmatic response in what you're going to get here. And it basically goes back to supply and demand. Could you have some normalization, some stabilization in markets? Could you have prices slightly decline in areas in Texas, Florida, Louisiana, some of these states where they have increased and have issues with homeowners insurance? Sure, you could have some year over year declines in prices, but is a crash going to happen? I don't see a world in which that happens anytime soon, just because of basic economics. So hopefully that's helpful. All right, Josh. Do you know about I don't know what this means. Can you share what you know about the ladder housing in California? Do you know what ladder housing is? No,
do not.
Can you enlighten us? Wendy,
if you have a link or anything, Wendy, let us know. We'll be happy to look at it.
Good stuff. Let's see. Official Bodie. I haven't closed on a home, but I'm locked in at 6.625% interest rate. Can I ask my mortgage broker to adjust it to the current interest rate before we close in 2 weeks? So Josh, it's always a good question. Can they adjust it? There's basically 0.3% difference, assuming they're a very well-qualified buyer than where rates are today. Can you just go to Josh and say, hey, Josh, dude, I know I locked it. Saw rates. I heard Josh talking about 6.375. I want that rate. Can I get it?
So first of all, we don't know anything about your scenario. If you have a 680 credit score and you're putting 3% down, that 6.625 might be an amazing interest rate. So let's take that into account. If you're putting 50% down, you have an 800 credit score, today's rate would be better. 6.625 is not bad, but let's assume that your same mortgage broker, if he were locking that today, if he could get you a 6.25, that's a big assumption, but let's say that were the case. Most lenders have a float down policy, and a move from 6.625 to 6.25 would be enough to trigger that float down. Generally, they want to see the market to have moved 100 basis points, which is 0.25% or more. So if that were the case, we have a 3/8 move, a 0.375% improvement in interest rates. And if that were the case, you would be able to float down. So that means you'd get 6.25. Most likely not. So most lenders have some sort of a cost for the float down, and you would end up maybe at 6.375. So a lot of hypotheticals out there. I'm not saying any of those things are true, but if you don't ask, the answer is always no. I would absolutely reach out to your loan officer, ask him, is there a renegotiation policy? How much has the market moved since we locked? Am I eligible? And they shouldn't give you any pushback or resistance, because from my end, it's binary. It's yes or no. Are you eligible? Doesn't change me. I'm not the one that's taking the hit. It's the investor is saying, hey, we have this loan locked. We have an incentive to get that thing to the finish line, and the market has moved enough that there's a risk that the buyer could move to a different lender if we don't accommodate them to some degree. And it is a compromise, and hopefully that would work and help for you.
All right, guys, it's been 1 hour. That is the end of tonight's show. We got some people saying thanks, so thank you for watching. If you haven't done so already, do us a favor, hit that thumbs up, subscribe to the channel if you want to stay updated on this. We do it every single Wednesday at 5 p.m. on Pacific Standard Time. So show up and ask your questions. We're going to update you on the economy. Next week, we're going to have talked about PCE. We're going to have talked about the jobless claim numbers. We're going to have talked about JOLTS, ADP. So there's gonna be a lot of data between now and next Wednesday. So make sure you stay tuned so we can update you on what's happening with all of that, because it is going to have an impact on mortgage rates and an impact on what the Fed decides to do. So we appreciate you being here. We appreciate the support. Until next week, guys. Adios.
Amigos.